Good evening. We are back with our monthly Netra. Last time when we were talking, I remember markets were close to 18,500. There was a lot of worry when people said that maybe Nifty will start to retrace from here. Today, we are standing at one of the record highs of Nifty, closer to 19,400. And I think the Netra consistently kept on saying that when markets are in momentum, when FII flows are coming back, it is a good time, and the bull market that we are in could go a few points higher and not lower. So with that conviction having been played out in the last month, we are excited to discuss what lies ahead. Like always, we'll focus on the key macro themes as well as the sectors that are having more opportunity at this juncture. Sahil once again has put in his heart and soul into making this presentation and releasing this on 5th of the month. So with that, Sahil, I hand it over to you to run us through the slides and what markets and early signals are saying as of now.
Thank you, Ankita, and good evening to all, and thank you for joining us today. So as we do 5th of every month, we come out with this report, and it's sent to all of you, and it's already visible on our website and our social media handles. So you can go and check the links at dspim.com. In the Netra section, you'll find all the reports. So in this report, what we've done is, in the July version, we've looked at 3 key themes. I hope my presentation is visible to all of you. I'll be using some of the slides to take you through the key aspects. So what we have done is that we've divided this into 3 key messages on external position, where India's external position is. Second is inflation, which has been a big worry. We'll try to discuss some of those aspects and what are the opportunities that we see right now today. So these are the key themes that we'll discuss today. And let's look at one of them initially, which is the India's external position. So one of the biggest problem for India has been very high amount of oil that we import, right? So I've written it here that this is a problem which has been a perennial problem for us because we import a lot of oil. So what we've done is that in this table that I've shown here, you'll see that there is one term called oil trade deficit, right? And we've taken a number of years. So particularly these 4 financial years. And why these 4 financial years? In these years, the oil price was $100, right? Which has been close to a life high for dollar. So in all these 4 years, oil was at 100. And again, we saw that in FY23, oil was on an average above $100, right? And when you look at all the, these numbers, what I've done is I've taken the average crude oil basket for India, which is the price that we realize, So these were the years where oil was a big problem for India, and I've taken all of them. And if you see these 4 years, average was $101. And we import a lot of oil. As I said, how much do we import? Look at the oil trade deficit number. So oil trade deficit is nearly $100 billion when oil is at $100, based on the amount that we import. And since then, because economy has grown, what we've seen is that when the oil prices again went back close to $100, we again imported about $112 billion worth of oil. This is adjusted for exports. So this is exports minus imports, and that's why the number is negative, because we export less petroleum products and we import a lot more oil, right? So when you look closely, whenever India has been in trouble in terms of external position, so you will know that India's external position deteriorated significantly. And for that, I will go to the next slide for a moment and come back on this slide. And if you look at, there are 3 lines in this chart on this slide. But if you look at, just only focus on the blue line, which is India trade balance, right? This blue line, you can see that there is a sharp deterioration in this blue line from the beginning of 2021 when the economy opened up, right? And you can see this sharp deterioration occurred because of 2 reasons. One, very large oil imports, and secondly, also very large other non-oil imports. So right now we'll focus on imports, which is a big perennial problem for India. And you can see that when oil prices go up to $100 or higher, we import more than $100 billion of oil. And it becomes a big pain for us. You can see oil trade deficit goes to 5% of GDP, right? In many years, it has gone very, very high. And that hurts us And you can see that our overall trade deficit, or what the merchandise trade deficit, goes up to as high as 10% in many years. It was in FY13, it was nearly 10% of GDP, which was a very, very large number. You can see that our current account balance was 5.7% of GDP, a very large number, and a number which caused rupee to plummet and India's situation to deteriorate significantly, right? But why this time those problems did not occur? And there are two very, very important nuances. One is that our position has changed on services and remittances. Okay, what are services? So, for example, we do a lot of IT exports and services exports. So we are net surplus. That means we are exporting more services than importing, and we run a surplus on it. What are remittances? NRI sending back money to India is remittance, right? Which is called private transfer. You can look at in these years when oil was at 100, the combined, these two numbers were between 128 to 142 billion dollars, right? This is the combined services and remittances inflow that we were getting when oil was at $100. This time when oil went back to $100, look at the total of these two numbers, 244 billion. Okay, so it could very well offset the oil trade deficit and could actually nearly offset even the merchandise trade deficit. So India's excellence in services exports plus a large amount of inflows which are happening because of NRIs and remittances which are coming inside the country, it has made the possibility that India's external position could improve significantly over the next few years. And why this is important? I'll give you one very, very important number. I have written it here, services plus remittance as a percentage of GDP. You look at this line, right, which I'm highlighting. I'll maybe erase everything else and then we will focus on this number. So I'm going to focus on this number, services plus remittance as a percentage of GDP. You see that this number is close to 7.2%, right? Through the series, right? It has kept pace with the GDP growth. What is the dollar GDP growth in this period? Roughly about 6%. Okay, this is the dollar GDP growth for India, which means that India's services and remittances have grown combined together at 6% growth rate in dollar terms. This is one of the sharpest and strongest growth rate which is available across the world. Okay, because when you do dollar denominated growth globally, you will find that countries struggle to grow beyond 2%, right? Which means that this segment for India has grown at a very fast clip. And there are reasons to believe that this growth will remain healthy. Okay, looking at the trends that we have and looking at the drivers of these trends, which means that over the next 5 years, our assumption is that if oil prices remain between $80 to $100 or go lower, we will not face a lot of external imbalance, right? Our external position will remain very, very steady. And there is a question that we have asked here: can India's external balance turn positive? I think this is something which nobody knows. We also don't know, but there is a conjecture that we have. And what is that conjecture? That if oil prices were to trade below $60, and this is an assumption, we do believe that there are reasons to believe that this could happen, but we don't know, right? We don't have any crystal ball to foresee that this will absolutely happen. But there is a probability that this could happen. Let's assume that if crude oil is at $60 or lower, and India's services exports, they continue at 5%. Right now they are at 6% CAGR. Let's assume they continue at 5% CAGR. And India's electronic good exports. And I have written electronic good exports because that is one place right now I have some recency bias, which is showing that there is a promise, right? They are showing tremendous growth. If they can grow from present 24 billion to 40 billion over the next 5 years, in absolute terms, our current account balance, which is right now in deficit, will become nearly balanced, or it will produce a very small surplus. Okay, and this is a condition which is probably not discounted today. Markets are unable to discount it. But when we go back in history and see example for country after country where the growth has remained steady and outpaced the global growth, plus those countries have tried to create export excellence, whether it is in services or in manufacturing, usually they have turned current account balance, right? Their current account is in neutrality, not in deficit. So there is an assumption that there is a possibility that over the next 3 to 5 years, India's current account could actually turn positive. And it has a lot of assumptions, which I've already told you. They may or may not happen. But I think there is a distinct possibility that this could happen. If this happens, what does it mean? One, that India's monetary policy, which drives a lot from global landscape, will become slightly more independent. RBI will be able to defend currency volatility a lot more easily. And secondly, domestically, I think flows will become very, very robust, right? And that means the inflows of foreign money will become very, very robust. And those, I think, has been very, very patchy over the last 10 to 15 years. If they become robust, it will open up a lot more opportunities domestically, both in terms of investment flows and also flows which come through FDI, right? So I think these two parameters currently are missing from market expectation. And my sense is that over the 2 years, this realization may dawn if these numbers play out. For example, if oil prices were to correct further and these numbers were to remain steady, right? I think this will probably begin to appear in numbers, and that will start changing the landscape for a number of sectors and ideas involved. Now let's look at the same number but from a shorter term time frame. And what I've done is that in this chart I've taken FPI flows, which is coming into equity markets, and India's trade balance, which is only the goods trade balance. So the trade balance is the blue line. You see that the trade balance, which was nearly neutral in 2002, 2003, we became large importers and it deteriorated significantly, right? It touched about $125 billion in 2008. And then for a moment, because of the recession, it slightly improved. And then 2012-13, we had the twin balance sheet crisis, huge amount of trade deficit, again, because of very, very high oil prices. Our deficit went to, on a rolling basis, nearly $200 billion, 188 to be precise. And then it improved because oil prices fell. And then again, 2018-19, if you remember, oil prices had again gone back up, right, before they crashed. And again, our deficit increased significantly. And then COVID happened and we went into a temporary respite from oil prices and we did not import anything. And then again, you had this whole reopening and trade deficit, which became worse. And you can see that this journey has continued. But what is happening in the very short term, by short term, I mean for the next few quarters, you can see that India's trade balance has started to improve from severe deterioration. It has started to improve and it has started to go higher, which means that the negative number is becoming smaller, right? Trade deficit is becoming smaller. Now, if you look at the green line in the background, you will see that India's FPI flows have also been very volatile. Over the last 10 years, barring this COVID surge, we haven't really had a major episode of FPI inflows other than that we had in 2011-12. But we did not have a significant inflow from FPIs in equity markets. This is one of the first instance outside of COVID. Of course, COVID brought a huge amount of valuation comfort in India. This is, I think, the first time that FPI flows have began and have remained steady outside of COVID, right? And the expectation is that when these two turn together, which means that FPI inflows begin, FIs start to put money in Indian equities, and also our trade deficit begins to improve. That means our trade deficit begins to become smaller. We have seen in all the past instances, currency volatility actually reduces quite a bit, right? And we've seen that these instances play out again and again. And in some instances, actually, rupee became extremely strong. In other instances, what we have seen is that rupee volatility goes down significantly. What does this mean? It allows the central bank to focus more on domestic problems. For example, domestic inflation and how is it running its own monetary policy, and allows monetary policy to remain more flexible. And second and more important point, if the global central banks, for example, US Fed and ECB, are in a easing mode and domestic liquidity conditions are good, Okay, this channel also helps Indian growth quite a bit, right? So I think from this data point, you can infer that both from a long-term perspective, which I showed you in the last slide, and from the short-term perspective, India's external position is a source of strength today, and this is likely to remain so over the next few quarters, unless we get new surprises or new data points, which we don't have today. So if there is a war or new development which happens, we'll have to incorporate that into our data points. But as of today, this appears to be a source of strength for Indian economy, for Indian macroeconomic situation. So this is the external position, and I think it is going to be a very important indicator going ahead. What does it mean for the monetary policy, which I've mentioned twice or thrice? So if you look at historically, when we had huge amount of FPI outflows, they have always coincided with RBI trying to control rupee volatility. So if you see these red marks that I've made, so there are two data series in this chart. The blue series is the Indian rupee, okay, which is on the right hand scale, and the yellow lines, which you see the bars, this is the RBI net purchase of US dollar. So if the line is higher, that means we are getting a lot of inflows and RBI is trying to sterilize it and by buying dollars. And if there is a lot of outflow, RBI is trying to sterilize it by selling dollars, right? Trying to stabilize rupee by buying rupee. So when you look at this data, you will see that whenever very large outflows have happened and RBI had to intervene to, purchase, to sell dollars, it has been followed by a period of calm. Okay. Sometimes that calm has allowed huge amount of inflows, which right now you're seeing that they have started to, materialize. And how significant are these inflows? So if you look at the data right now, in the calendar year 2023, I think India has got about $12 billion in inflows. But if you look at financial year 24, which is April to 10th July 2023, only this financial year, we've got about 16.5 to $17 billion in FI flows. If you add FDI flows of last 3 months, we've got about 22 to $23 billion of net inflows, which is a very large number. So let me give you one more data point. I think the biggest inflow that we had was $45 billion from FIs, I think in FY12, out of which 27 billion was debt money. So if you disregard that, the highest inflow that we've got was $36 billion. That $36 billion translates to about $3 a month, okay, which translates to about $9 to $10 billion on this FYTD number run rate. Current run rate of this financial year is about $18 billion, as I told you, 16 to $17 billion, which is one of the highest and fastest pace of inflows that we've seen from FIs. So I think these numbers, most likely they will taper off for a few months, but I think they are possibly going to be more structural in nature than a lot of people believe. And this, as I said, will allow RBI to create a healthy kitty of FX flows and also provide more stability to the rupee. So the first 3 slides talk about one thing. India's external position is strong. It might spring a surprise in the next 2-3 years by becoming even more stronger. And from a shorter term perspective, it gives RBI a lot more ammunition to exercise its own policy rather than looking at what the Fed is doing or the ECB is doing, right? So these are the clear 3 key takeaways from the first 3 slides. Second is we are going to focus on inflation and look at a number of factors, El Nino being one of the most prominent ones, where a lot of people have been, talking about what's happening in this weather phenomena. Interestingly, over the last 2 weeks, India has received so much rainfall that we are now in a surplus, right? So first thing is, what is El Nino? It's a weather phenomena, okay, which causes, in short, it causes variability of rainfall. Whenever there is a high intensity El Nino, it reduces rainfall activity over India. Okay, it does a lot more things. I'm just simplifying for our conversation today. And we've looked at data for over 60 years in terms of when El Nino occurred. And you will be able to see this data here. Look at this El Nino intensity. Whenever there is strong El Nino, we've got a drought. Okay, major drought in India. Again, there was no El Nino in 1966-67, but there was still a drought in India. because of other reasons. Okay, you can go back and read these reasons. I'm not going to possibly spend time on each year, but roughly you can see whenever there is this red mark, there is a strong El Nino, you will see that there is a major drought, or even in terms of weak El Nino, we had major droughts because we had other problems. What were other problems? Our area under irrigation was very small. So in 1960s, 70s, 15% of India's agricultural cultivated land was irrigated. That means it was getting water from set sources, whether canals or streams or groundwater, right? But if you fast forward to today, almost 54 to 58% of India's cultivable land is irrigated, okay, using canals and groundwaters and water pumps, right? So the intensity of El Nino matters slightly less today because we have other fighting mechanism. And secondly, and very importantly, we have not faced a strong El Nino for the last 20 years. So last time we had a strong El Nino was in 91, 92. You can see that, right? Even in that year, we did not face a major drought. The rainfall activity was also fine. So in fact, this combination of a strong El Nino, poor rainfall activity, and therefore very poor crop production, we haven't faced in the last 30 to 35 years. This combination we have not faced. What does this mean? Can we face this combination? Yes. There is always a possibility that this combination can reoccur. What is this combination? Very strong El Nino, which causes poor rainfall activity, which means a drought, which causes very sharp drop in crop production. And therefore, what will be the outcome? A, high inflation. Secondly, very poor Agri GDP. That means our agriculture GDP will fall. So historically, there are two very clear data points. One, whenever there is a strong El Nino and therefore its impact on rainfall activity, our Agri GDP goes down significantly. Okay, we've seen that the numbers fall anywhere between 2.5% to 4%, which is a very large number for a cut on India's Agri GDP. That means if agriculture GDP was growing at 5, it starts growing at 2 or 1%. Okay. Second important fact that we've seen is that whenever there is this combination, inflation goes up significantly in food products, right? But recently we've seen that the impact has been muted. And as I said, why the impact is muted, one, because a lot more land is now irrigated. For example, if you look at the top food grains that we produce, which is wheat and rice, and the major producing areas like Punjab, Haryana, and Madhya Pradesh. Punjab and Haryana have 99 to 89% cultivated area under irrigation, right? Madhya Pradesh has about 50%, 48 or 50%. So a lot of these large food crops are not reliant on rainfall activity, right? And therefore, our ability of El Nino to impact our crop production and therefore influence prices has gone down significantly. Second thing is that you see these episodes of very high inflation. Usually they coincide with high food prices globally or very high MSPs, which government gives to farmers to sell crop domestically, right? Right now, when you put, pen to paper, all these three segments are missing. A, do we have a very strong El Nino? As of today, we don't have. There is a expectation that by the end of July, El Nino intensity could go up significantly and rainfall activity could fall. We don't have data as of today. We'll only come to know in August. So let's wait for that time. Do we have a very large impact on rainfall activity? Distribution-wise, yes. But on the whole, no. Right? Third is, do we have very large impact on crop production? The first survey will come on 5th of July, the crop production survey, and we'll come to know that. So from data perspective, it is very clear that the impact from El Nino could be muted. And even if there is a very large impact, we'll only come to know closer to end of August or beginning September that there is some impact which is beginning to occur. For now, it does appear that it is possibly going to be a non-event, right, on India's inflation. And in the short term, we've seen there has been a huge spike in certain food product prices. And they can contribute to inflation, but we've seen that they are very, very seasonal in nature. As soon as the first crop comes back, prices fall 50 to 80%, and the numbers die down significantly. Sometimes the impact it goes on for a few weeks. Sometimes it has gone up for a few months also. But we've seen that eventually it is very, very cyclical in nature and seasonal in nature. So we should not pencil in those numbers for a longer term impact. And usually RBI, sees through these impacts rather than acting on them. Second is India's inflation. So one thing is very clear: our inflation trajectory is much more benign, barring what we are seeing right now because of 2 or 3 food articles. Our inflation trajectory is going to be close to 5% or maybe slightly lower than that for the rest of the financial year. Maybe we'll spring a surprise by giving a higher reading because of food prices. But if you see all the components of our inflation, whether it is food and beverage, clothing, miscellaneous, core inflation, all of them have cooled off. They have cooled off to levels that we've seen pre-COVID, right? They've gone back to those levels. And it does appear that we are in a more benign inflation environment than we've been over the last 2 years. So this possibly is going to continue unless there are new signs that new inflation drivers are emerging. We believe that inflation is probably going to be in the RBI's comfort zone. Second is, let's look at what's happening in US inflation. Again, a very, very important parameter to look at. And here, if you see, there are two charts. The upper chart that you see shows the components which have caused inflation, right? So let me expand it a little bit so that you are able to, see it much more closely. You can see that services inflation, which is the red component, has remained very, very high. All other components, for example, food, energy, have gone down, right? For example, energy has actually become net negative. And this is what we highlighted last year also, right? The component which is driving US inflation, 90% contribution is coming from services inflation. So when you split up these inflation numbers further, you will find that housing inflation is a very, very large component. So 1/3 of all inflation comes from housing. And what we've seen recently is that housing inflation has also started to fall based on the lead indicators that we watch. And the real component, which is the CPI urban consumer owners equivalent of rent, right, which is a US inflation component, that also has peaked out, right? Although it remains very, very high at 8%, our expectation is that over the next 3 to 6 months, this number will also cool off. Today, the US Fed is entirely focused on core inflation. Earlier, it was talking about headline inflation. Today, it is talking about core inflation. And largely, it is buying time for hard inflation data to come down. And our internals inflation data that we watch are telling us by the time we are in September, I think we have made these comments even in earlier Netra presentations. We commented that by the time we reach September 23, US CPI inflation headline will be below 3.5%. And I think we are very close to that level. The reading that we'll get in 2-3 days will be closer to that number. On core inflation, our models tells us that by the time we reach December of 23, core inflation will be sub 3.5% in US. Again, which is going to be a very, very favorable outcome for the US Fed, right? How do we know this? One, I have already told you that housing is beginning to turn around. Second component is what happens to US services economy. So service sector growth has been very, very strong. It has been holding up labor market in US, inflation in US. So we looked at US economy and we weighted the economy for manufacturing and non-manufacturing, which is services sector. And we looked at the composite index. So which is this orange line, right? So when you look at this, when this orange line dips below 50, right, which is on the left-hand scale, you'll see that a recession in US, it starts in US, right? And whenever this happens, US inflation also falls. This is the core inflation which the Fed is talking about today. You can see this happen time and again. Whenever US economy enters a recession, and when does this recession start? When the economy based on manufacturing and services, PMIs both dip below 50, right? Currently, it is very close to this level. Recently, we had services PMI coming in at 53, which was a tad higher than expectation. So it is hovering closer to this 50 mark on a composite level because manufacturing PMI is already negative. Our thought process is that over the next 3 to 6 months, this will probably dip lower, again causing the services component of the economy to slow down. Right now, the signs are absent, but when you look at the advanced data, everything is slowing down. Although the slowdown is happening at a very gradual pace, right? It is not accelerated. And therefore, it doesn't appear very, very closely in number. Maybe if the slowdown had to occur in a quarter, it is happening in 3 quarters, right? But data is slowing down. Over the next 2 to 3 quarters, we'll see that these numbers fall, and therefore core inflation, which is still very high, closer to 470, will possibly come down. And that is how monetary policy, both in India and US, will get back in sync. Right now, they're out of sync. US is in pause. US is hiking rates or talking about hikes. India has paused and is reluctant to increase rates. Even for that matter, all other emerging markets are reluctant to increase rates, but US still wants to increase rate, right? And that is something which is possibly going to change over time once these numbers come down. So this is on inflation. One, that El Nino possibly is going to be a less of an impact until it becomes intensified, and the three effects which I told you, strong El Nino, very strong drought, and therefore poor crop production materializes. Till then, I don't think it's going to be a very impactful activity. Second, India inflation is normalized. Third, US inflation will normalize in the next 2 quarters on the core aspect. Headline has already fallen, right? Next is the number of opportunities that we see. First is that globally, we've seen that smaller companies have underperformed significantly. By smaller companies, we mean we have taken 2 things. One, when you look at MSCI Emerging Market Index, which of course is a number of countries put together, but these companies in these countries are much smaller than their counterpart in developed economies, right? For example, having $100 billion company in India is a mega cap, right? Which is not even a, most of the S&P 500 companies will be much larger than, $10 billion in market cap, right? $100 billion, I think there are more than 100 companies, right? So from a size perspective, developed markets are much larger, and you can see that they have outperformed emerging markets on a grand degree. Over the last 13 years, emerging markets have underperformed US equities or world equities. Similarly, when you go to US, S&P small cap has underperformed NASDAQ stocks significantly, both from a size perspective, because NASDAQ companies have become mega caps, right? 3 of the top large cap companies in US are technology companies, right? And they have outperformed the small cap companies again for 13 years. Before that, outperformance was halted in 2020. But in the last 12 months, again, small caps have underperformed large caps in US significantly. So one thing is, we believe that this tide of big becoming bigger has possibly hit numbers which are far away. For example, I'll give you one data point. The market cap of top 7 companies, which are now being called Magnificent 7 in US, as a percentage of S&P 500 market cap, is now 32.7%. This is the highest number in last 150 years for any large 7 companies, right? And their profitability, the share of their profit, has fallen from 10% to 3.5%. So the market has clearly given these companies much larger multiples. And the other part of the market, which has become much cheaper, for example, small caps in US are trading at 14.5 times. Similarly is the case in Eurozone or Japan, right? So market has gotten divided, gotten at an extreme for some of the larger and bigger companies, and has gotten to the other extreme for smaller companies. And we believe that this tide will turn. Most likely we are at an extreme. Do we have the signs for these tides to turn? I think there are signs in terms of extremity. Some geographies have begun to show that small caps have started to outperform, for example, in India and some of the other emerging markets. But in most countries, the turnaround signs are still absent, right? So we'll have to wait for these turnaround signs to come back. But one sign is very clear, that the gross margins or profit pools of very large companies from an evolution standpoint has become very, very difficult to continue. For example, at $3 trillion market cap for Apple, if it grows at 10%, over the next 6 to 7 years, it will become $6 trillion in market cap, which itself will become almost 5% of global GDP, right? which has never occurred in the past. So if you take out 200, 300 years of data also, this goes beyond the extremities that we've seen from a very longer term perspective, right? So usually we've seen that these signs occur at the fag end. And so what we are saying is that look at the other end, which has become cheaper, which is the smaller companies across the world. And whenever you see signs that these companies on a short-term basis, on a 6 months or a 1 year basis, have seen a drawdown, become cheaper, that is a time to favor these companies, and possibly they are going to give you a smoother journey versus the overtly expensive and large cap companies which are available in the world today. The next is the Indian stocks, and we put out this on 5th, and we have seen about 6-7 days of price action. So historically, what we've seen is that this is NSE 500, which comprises of 500 stocks. When 80 or more stocks make a new 52-week high, which is these green bars, right? The red bars are stocks making 52-week lows. Green bars are stocks making 52-week highs. So whenever the index is at a lifetime high and more than 80 stocks make new 52-week high and this reading continues, usually the new highs continue. The market has the required breadth and the health to continue to make lifetime highs for some more time, right? So we believe that we have got the reading above 80 in the last 2-3 days, and the new highs have also come in. So we believe that most likely this bull trend in the market should continue. It will have its own intermittent correction. For example, large caps are now trading at 22 times trailing multiple, which is very, very high, right? Just a few months ago, about 2-3 months ago, it was trying to touch 18 and a half times. So we've seen a 10-12% rally since then. And now new numbers will come in, new results will come in. Most likely large caps could see some amount of consolidation, but we haven't seen very deep corrections historically from markets which have been making lifetime high, right? It takes a while. Roughly, statistically, what we've seen is that if market makes a new lifetime high, it takes about 6 months for them to top out and start to correct significantly, right? So which means that the price action continues to favor you being in the trend and participating. At best, what you should do is that when valuations become expensive, try to look at sectors which are appropriately priced. B, stagger your purchases. I think that is the best strategy to do, and that is what we are also recommending today. Looking at last 2 slides in terms of sector, one is NBFCs, and we've seen historically what happens is that when spreads of NBFCs, for example, if you look at these 2 lines we've put out here, one is banks relative performance to NBFCs. You can see for the last 12-14 months, they were outperforming NBFCs, banks were outperforming. The other line is NBFCs AAA bond yields minus term deposit rates. So it shows you how much of monetary policy or interest rate cycle impact is happening on NBFCs borrowing, right? So if they are able to borrow at cheaper rate when rates fall, usually they will be able to navigate the interest rate cycle better. And that is what we are expecting. Second thing is the franchises are very, very strong on NBFCs. They are able to play the rising credit growth scenario much better than banks. That is what we've seen historically. And during a down rate cycle, because they are wholesale funded entities, they benefit a lot more when the cost of funds decline, right? So when interest rates are declining and their cost of funds decline, when you compare a bank versus an NBFC, NBFC will be able to take much more benefit than banks. And that's why we feel that NBFCs could also join the BFSI uptrend. And we have, number of ideas focused on this theme. And NBFCs are significantly large in India. They have 24% of the banking system market share. So there is no reason to believe that they are not, they don't have scale, and they can create a lot more profitability than what they are creating today. The last one is healthcare, which has been one of our go-to sectors over the last 6 to 9 months. And you can see from a healthcare perspective, if you break it up, US generic business is trading at a much cheaper multiple. And you can see on a EV to EBITDA basis, relative to Nifty, it's at one of the cheaper places. On a pecking order, one of the cheapest sectors across the sector universe. And when you look at BSE healthcare EV to EBITDA also, it remains very, very attractive overall also, right? Generally below average multiples that what we have seen. So healthcare remains a structural story. We believe that it will continue to do well over time. And on a relative basis also, the sector remains very, very robust, right? So these are all the slides that we had. And the one final slide that we put here is all the advice and knowledge that we share. If we utilize it, for example, the opportunities that we are sharing with you in terms of healthcare, in terms of NBFCs, we implement all these activities in the number of strategies that we run. And you can also pick these activities and implement them in your portfolio, because the idea is that if you know it and if you don't implement it, it is as good as not knowing, right? So expertise, and the idea is to seek and build expertise, and that is what gets the premium in the market, both in terms of valuation and in terms of asset allocation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.